Well, good morning and welcome to St Philip's Chambers breakfast talk. You'll notice that we're a man down. I'm Petar Starcevic. I'll be talking on interest and tax in employment cases. Joining us later will be Paul Wilson, who will be dealing with schedules of loss and orders for deduction. Now, this is going to be a real whistle-stop tour, and I'm going to start off with looking at interest. Now, those of you that practice in the civil courts know that the county court and the high court have got a statutory power to award interest in their discretion, both as to rate and also as to period. The Employment Tribunal is different. The Employment Tribunal has no inherent jurisdiction to award interest. All its powers and jurisdictions are creatures of statute. And in the Employment Rights Act, there is no provision for awarding interest. So most of the ordinary employment claims, which includes deductions from wages, for example, unfair dismissal claims, there is no power to award interest. Now, there is one case which you can do a slight outflanking, and that's the case of Media against Magna Cansai. And in that case, the Court of Appeal affirmed that the tribunal had no power to award interest. But what it did, when it looked at future losses, it agreed with the Employment Tribunal that rather than give a discount for accelerated payment, and those that do personal injury law will know that if you're getting future losses awarded as a lump sum, as at the date of trial, you're getting your money early. And so it's common to make a discount for accelerated payment. Well, in that case, there was past losses for which the tribunal could not award interest, but there was also future losses, which would normally be the subject of a discount for accelerated payment. But what they did to make an award which is just and equitable in all circumstances, because they couldn't award interest, they did not make the discount for accelerated payment. And so the claimant, almost by a side wind, effectively got interest on his interest. That's the interest on his award. That's the only means you've got of outflanking that. It's different once a judgment has been made. Once a judgment has been made, then the awards from the date of judgment carry interest at similar to the county court judgment rate of 8%. What about discrimination cases? Well, it took a case to go to Europe to say that the then Discrimination Acts didn't comply with the directives because they did not have the right to and power to award interest. And so that is why we got, by separate regulations, the power to award interest. But it's different to the county courts and the high court of a general discretion. It's an obligation. So they've got an obligation to consider interest and a discretion to award. But the regulations are much more prescriptive about the rate and the period of interest, and it defines the period of interest. So in injury to feelings, interest runs from the date of the discriminatory act. In financial losses, it's from the midpoint of the accrual of the loss. And it appears that the discretion is limited because they've got to award on that basis unless in the period there's serious injustice. Now, I've come across tribunals in the Manchester area which in the days when interest was very low, and yet the rate which is prescribed for discrimination awards of 8% is quite high, they exercised their discretion to say, no, we're going to award it at a lower rate. Now, whether or not they were proper in doing that remains to be seen. And I acted for a respondent, so I didn't object. But be aware that some tribunals may see their discretion on interest in much wider terms. Okay, that's all I propose to say about interest. In summary, you've just got to be aware of when you can and cannot get interest. And in discrimination cases, be aware that the discretion is rather more circumscribed. It's an area of law where, if you know the case in media, you could perhaps outflank and get a little bit extra for your client. What about tax? Tax is an area where, if you are not cognizant of the impact of tax on your awards, you can really make a major boo-boo. And if you're acting for a claimant and you accept in settlement a particular sum, you may suddenly find your client coming back to you saying, hold on, I thought I was getting this sum, I'm actually getting a lot less than this because of tax. So let's talk about tax and the various regimes that apply. There's a huge tome of a statute, the Income Tax and Pensions Act. And we all know that those in employment are subject to tax, and employment is defined very widely under Section 62. And I'll perhaps refer to the tax on emoluments from employment as the Section 62 charge. And may I say at this stage, you're going to be sent out, those that have attended are going to be sent out a written handout that I've made both on interest and on tax. So there's no need to furiously make notes as I speak. But the Section 62 charge is the normal charge to tax that you'll be paying. Basic rate 20%, high rate 40%, etc. But although emoluments is defined very widely, what about compensation in a claim linked with your employment? And the case of Hofstrasser and Mays that I've got on the slide there was a case where there was a compensation scheme for those in employment of a bank who had to move around the country because they had to move as part of their employment, and they got money to pay the expenses of the move. And that went to the higher courts, who said, well, no, that's not an emolument from employment, that's compensation. And so that sets the ground on which it said that the awards from claims are not emoluments and earnings from your employment, but are compensation, and so are not subject to the Section 62 charge to tax. Now, whether or not Hofstrasser and Mays would be decided in the same way these days is a different matter, because there are cases, and in the handout you'll see one where compensation was given for changes in contracts following 2P. And the employees argued that it wasn't an emolument, it was compensation. But the tax tribunal said that because the employment relationship was continuing, the reason, or significant reason, for the payment was to keep goodwill and continued employment of the employee. It was therefore charged to tax. But in the Employment Tribunal, the awards made generally concerns completely discrete claims or are in consequence of dismissal. And so it's much clearer that they are not subject to the Section 62 charge to income tax. Well, this exception led to an awful lot of golden goodbyes, where people would dress up their settlement agreement and make a payment that was not subject to tax. And that's why several decades ago now, there is brought in what is now the Section 401 charge to tax on payments in connection with termination of employment. Now, if you look at Section 401, there's a number of other payments that are also covered. For example, giving up restricted covenants or being subject to restricted covenants are also covered. But the broad definition of the charge to tax arising under Section 401 for any payment in connection with termination of employment is extremely wide. The important point to note first about this charge to tax is that the Section 401 charge only arises if the payment being made is not otherwise subject to tax. So if any payment was subject to tax under Section 62, for example, if it was an unlawful deductions claim or the like, then it's not going to be subject to the Section 401 charge. So it's a residual catch-all provision. The other important point to note about the Section 401 charge is that it's subject to an exemption of £30,000. So the first £30,000 is not taxable at all. Now, that £30,000 has been in place ever since I can remember, and it's decades ago, £30,000 was a good chunk of money and covered most settlements and claims. Now, the position is otherwise. Most claims of any substance are going to exceed the £30,000. And so this Section 401 charge to tax is becoming more and more important. So let's see what is subject to that. Is it all payments that are in connection with termination of employment? And what payments are not subject to it? Well, if you look at the statute, you'll see that there are a number of exceptions, minor ones that don't come up, payments in connection with the car and things like that. The two big ones to note are the exception for legal costs and costs on account of injury. So let's deal with legal costs first. No particular definition of those. The importance of mentioning it is that you can structure a settlement to pay legal costs and it will not be subject to the Section 401 charge. Now, no one's suggesting that you structure a settlement to avoid tax, and you certainly can't say, give it the label of this is in respect of costs if the claimant hasn't, for example, got the legal obligation to pay his lawyers. But that is something to think about where you've got a private client who's paying his legal costs, that any global settlement, you could apportion some of that to the legal costs that he's actually liable to pay, and then that will go outside of the charge to tax under Section 401. The other exception, which is of importance, is payments in respect of injury or disability. Now, this is designed to cover the case where the employee accident at work, traumatic accident at work, cannot continue in employment, and is dismissed through capability, brings a PI claim in the county court, and then the whole of his award, including loss of earnings, is outside the Section 401 charge, even though part of that meant that it was because he was, it's connected with termination of employment. That was one of the reasons why he's being paid the compensation. Well, what is personal injury? Personal injury lawyers recognise and know that a personal injury is a clinically recognised disease or condition, and so it'll be recognised under the International Classification of Diseases of the World Health Organization, for example, or by a body of medical practitioners, but a recognised clinical injury, different from injury to feelings, because injury to feelings, which under the Vento guidelines get substantial awards, nonetheless are short and takes into account feelings which are short of a clinical injury. Now, of course, there will be many discrimination cases where there will be an element of depression or post-traumatic stress disorder, even in the extreme cases. So there will be an element of clinical injury. So when you're in the Employment Tribunal, you'll be claiming both for, in those cases, injury to feelings, but also a separate award, normally supported by an expert medical report, establishing, proving a clinical injury with a condition and prognosis. Now, what happens with the injury to feelings? Well, there was a case in the Court of Appeal called Morphy, and I can't remember, the Eye Hospital in London, which said, yes, that is an injury. That is outside, it's an exception to the Section 401 charge. Well, the government didn't like that, and so amended the statutory provisions to make clear that injury to feelings are taxable under Section 401. But that's not the whole story, because there will be cases where you've got a claim for discrimination with a claim for injury to feelings, but there is no termination of employment. Those, of course, aren't caught by Section 401 because there's no termination of employment to be in connection with. There will also be cases where you will have discrete acts of discrimination causing injury to feelings whilst the employment relationship is going on. But then at the end and later, there will be either a dismissal or a constructive dismissal and then an award. So can you, and I suggest you can make an apportionment between injury to feelings for those which are whilst the employment continued and injury to feelings which are in connection with the termination itself, if that's the discrimination award involves termination. And so it will only be the latter which are taxable and subject to the 401 charge. Okay, so what happens when a Section 401 charge is made? Firstly, it's the employee, it's his tax liability. So ultimately, the employee is liable to pay that tax, but it's subject to PAYE obligations. And so that means the employer, the respondent, is liable to deduct that tax. And so if you're acting for a respondent, you agree a lump sum payment and you simply pay it to your claimant, and you think that's the end of the matter, you may be wrong on that, because HMRC will go for the easiest target, and the easiest target to enforce the payment of the Section 401 charge is going to be the employer. And the employer who fails to deduct the Section 401 charge to tax and any other tax is going to not only be liable to a penalty potentially for breach of the PAY regulations, but will also have to pay that tax and fine. They can say, right, well, we've got to try and get this back off the employee, but you're chasing a difficult target there. And Section 401, I said it's a charge to tax. It is, and in the employee's hands, the employee has to pay his income tax on the termination payment. He does not, and it's not subject to employee national insurance contributions, but it is subject to employer national insurance contributions. So when the employer is chased for payment for this and has to deduct this charge to tax, the employer also has to pay the employer national insurance contributions, which of course are just about to go up. So that's the Section 401 charge, and let's see how that has to be dealt with. And before we do that, I'm going to talk to you about notice pay. Now, historically, notice pay was dealt with in the normal way for damages, in that it was calculated as net of tax, and then damages were awarded, and if there was a charge to tax because it was it exceeded the 30,000 limit and was charged to tax under Section 401, then the tax that would have to be paid would be added back into the award. So that was an advantage for employees, because even by agreement, or if in the constructive dismissal claim they simply leave immediately and don't serve their notice, rather than working their notice and getting taxed on it, they get their money free of tax, at least for the first £30,000. Well, as a taxation exercise, and to prevent tax avoidance by means of parties agreeing an immediate termination and a termination payment without regard to notice, or effectively outflanking what would otherwise have been income tax on the notice period. And this is why in Section 402, big A to D of ITIPA, we've got the, I think relatively new in the last few years, taxation on post-employment notice pay. And if you care to read Section 402 A to D, which I don't recommend, you'll find it very difficult to understand, but the intent and effect is that untaken post-employment notice is deemed notice pay, and it's subject to income tax. It's subject to income tax, employer national insurance contributions, like the Section 401 charge, but it's also subject to employee national insurance contributions. Like Section 401, it's subject to PAYE, so it's up to the employer to deduct those. Another way of thinking about it is that whatever notice period is left, and the calculation involves whether or not you take off holiday entitlement, etc. But the unworked, untaken notice period is taxed just as if that period had been worked and all the tax, income tax, both sides national insurance contributions are paid. Importantly, this charge, the notice pay charge, gets paid in priority to Section 401. And so tax during the notice period, and this affects all wrongful dismissal claims because inherently it's for untaken notice, will be subject to this 402 charge and cannot then also be subject to Section 401 charge. So whenever you've got a lump sum payment, you'll first be thinking, what is the untaken notice pay? And that will be paid with income tax and national insurance contributions. What's left of the compensation payment? Is it in connection with termination? If so, then you take off the £30,000 and you balance is what is subject to the Section 401 charge. And how do we treat that figure? Well, we go back to basic principles that in the measure of loss and unfair dismissal, discrimination claims, they're all statutory torts, and the measure of loss is the sum of money that would put the claimant in the position they would have been in had the tort not been committed. So had the discrimination not occurred, had the dismissal not occurred. But that's compensation is what has got to be in the claimant's hand. And so although following Hofstrasser and Mays, we assess compensation on a net basis, we then take into account the charges to tax under Section 402 notice pay, and then we take into account the Section 401 charge, subject to the £30,000 exemption. We will then come in with, well, there's a tax liability there. Well, in terms of what the employee must receive, he's got to receive that free of tax. And so you've got to adjust the award so that the employee gets that true compensation, the true measure of loss, free of tax. And that's what we call grossing up. Now, how do you do the grossing up? If you read the textbooks, you see the examples of cases where they simply add the tax back in. As a matter of practicality, what you can do is there's various online tools which give you the grossing up figure, and you can consult those. But beware, that may be fine for when you're doing a Section 402 notice pay calculation, because that grossing up on most of the online tools will gross up not only for income tax, but for national insurance contributions as well. But bear in mind, for a Section 401 charge, when you're grossing that up, yes, you've got to take into account the tax, but there is no employee national insurance contributions. So you do the grossing up. But that can be a sort of unfairness for a claimant. What about the unfair dismissal claim where there is the statutory cap? And it may well be that, I can't remember what the statutory cap is now, something north of £100,000. That may be his true loss, £100,000, but then the employee finds that he's liable to tax on that, and it takes him up to £140,000. Well, still the statutory cap applies. And likewise, in the statutory jurisdiction of tribunals to deal with breach of contract claims, the cap of £25,000 applies. And so if there are charges to tax which take it above that, it's too late for you. The tribunal has its jurisdictional limit, and that's the end of it. So how can you do best by your client? Now, my first piece of advice and suggestion to you is that you should start by trying to define the amount of post-employment notice pay, if there is any. Define that and know that that's got to be paid tax and all national insurance contributions. If you are running an apportionment for personal injury claims or legal costs, do that in your compromise agreement, or try and invite the tribunal to make that order. And so, for example, you will have a separate sum for psychological injury. That's a separate head of claim. Next, on the injury to feelings, is there any scope for apportioning injury to feelings prior to dismissal and unconnected with dismissal? If there is, then make a bona fide and realistic apportionment that may save you tax. Well, you ask, will the revenue live with that? Well, that's up to the revenue, and they may try, they'll challenge an unrealistic one designed to avoid tax. But if you've made a genuine apportionment, then it may well be that they will live with that and not challenge it. And then always clarify the amounts that are subject to tax and have got to be deducted as pay as you earn. Now, if you do that, and my segue into the talk by Paul Wilson, who I hope is going to arrive soon, will be when you're a claimant drafting your schedule of loss for the Employment Tribunal, you ought to have these apportionments in mind so that you know in advance what each head of claim is and what the tax impact of that is. Now, have that in your schedule of loss. If you settle before a tribunal order, then fine, have that apportionment in your settlement agreement. It can only help you when you're dealing with the revenue. If you don't have a settlement and you get an order from the tribunal, invite the tribunal to carry out those steps and make the apportionment of its award under those headings, because then you'll know exactly what their calculations are. If it turns out and you get back to payroll and the accountant says, oh no, that's wrong, the tax is actually more than this, at least then you've got a much better basis for coming back to the tribunal for reconsideration to try and get the answer right. So that's the end of my talk on interest and tax. Have we got any news on Paul?
We have. Good morning, everybody. And for anyone who knows Paul Wilson, you'll know that I'm not Paul Wilson. Unfortunately, Paul has succumbed to the traffic on the outskirts of Birmingham this morning and isn't going to be able to make this session. So he's asked me to apologise to everybody, to you as well, Petar.
That's fine.
Unfortunately, Paul can't be with us this morning. So I don't know, Petar, if you've got any more words to say, or whether that's.
Well, no. What I can do, and you may have to stay here, Guy, in order to activate this. There is a Q&A session on this, and I can open up to listening to your questions if you've got any. I'm not guaranteed to have the answer, but an interesting and stimulating Q&A is the answer. When you get my handouts, you'll see that particularly taxation is a much bigger subject. And, with advance warning, I could speak for an hour on that, and you would not be bored. So take the trouble to read my handout when you get it. What you've had this morning is a whistle-stop tour. So, Guy, are we able to?
Yeah, either via the chat or the questions and answer tab within Teams. If you do have any questions, please post them there, and I'll share them with Petar. Nothing yet.
So we've got a question. Oh, can you? Is there a cap that can be apportioned to legal fees? No, not aware of any cap that can be apportioned to legal fees. I think if your claim is in the county court or the High Court, obviously there is a separate order for costs, and you just know that is dealt with completely separately, and so you don't have to worry about it. If you're in the Employment Tribunal and you have a fault hearing, an order for compensation made, and then you apply for costs, and it's one of those cases where, yes, costs have been unreasonable in the conduct of the litigation. Tribunal makes an award of costs because it can only, it can't just make it by consent. It can only it's only got the power and jurisdiction to make an order for costs if there's been unreasonable conduct. If you get an order for costs, then fine, that is not subject to tax. What I was talking about this morning was the possibility that you can, when you're representing a claimant, you can say, who's paying privately, look, of this settlement sum, he's got a liability for costs. We want to put that towards the costs. Now, so long as that is genuine and he's got that cost liability, then there's no limit to it, and revenue will just have to live with that, because that's going to the payment of costs. Obviously, any award for costs and any agreement for costs is subject to the indemnity principle. You can only claim costs that you're actually liable to pay your solicitor. So that's the
one more. And
answer to that one.
What websites would you recommend to carry out the gross number?
Well, to be honest, I did it the old-fashioned way, and it was when I was in the tribunal up in Manchester that the tribunal, because if you're in a contested claim and I was a respondent, and you don't know what they're going to award, all you can do is just give them the principles and say, this is how it's supposed to be done. You try and do it. And the tribunal came back and they said, well, we use one of these online tools. And I have used them since. I can't remember what they are. There are various about. My only word of caution is that most of them will give the grossed up figure for national insurance contributions as well, including the employee national insurance contribution. Remember, for the Section 401 charge, there are no employee national insurance contributions, and so you're better off just adding the tax back in yourself on that, because it's a much simpler calculation. And I may say that whatever you do by way of calculation in adding the tax back in, these Section 401 termination payments are subject to a special tax coding, a zero tax coding, which means they're going to be taxed as if they've got that all received all in one tax period. So warn your client, your claimant, you're going to be subject to the highest rate of tax on this that's available for this money, and it's going to be up to you, if there is an overpayment of tax, to reclaim that back at the end of the tax year when you do your tax return. Okay.
So, any tips for persuading the employer to agree to portion a separate part of the compensation for injury to feelings in a settlement? They never agree, as they want the settlement to be without admission of liability.
Well, there is no. I understand that a lot of respondents will say that this is without liability. Here's a lump sum up to what you want to do. But there's no inconsistency between saying, right, this is a payment without liability, and saying, well, the sum that we're paying is apportioned as follows, because there's going to have to be an apportionment between for the notice pay, for example. The biggest incentive that you can have when leaning on an employer, and really it's in an employer's interest to do this as well, is that if you don't have that sort of apportionment, you can say, well, we're not settling at this because we're just not going to get the compensation. And if we go to tribunal, your liability, because of the implications of tax, are going to be that much more. And that's another reason why, when you're a claimant and you draft your schedule of loss as ordered by the tribunal, that's why you should say, right, this is the notice pay. It's got to be it's going to be subject to tax, and so it's got to be grossed up for that purpose. This is the payment in connection with termination of employment, subject to tax, and this has got to be grossed up, because the more you do that in the schedule, the more it doesn't inflate, it gives a realistic figure, and that's going to make the employer, the respondent, think this is the level of my exposure. If you put those tax calculations in, it's not really, it's better practice than simply calculating and setting out your losses on a net of tax basis and then saying the claimant will claim the tax just as an end. Put the figures in and make the employer know exactly what they're going to be exposed to, so that they know, and their lawyers can say, well, look, if we do this apportionment, we can get the settlement down to a more realistic level. I've done, as a respondent solicitor, you can say, I've done good for you. And as a claimant solicitor, you can give them, the respondent solicitors, that wiggle room to say, look, they've saved their clients some money from what would otherwise be the award in the tribunal.
Why would any injury to feelings which happen during employment not be subject to an S401 charge? Would they instead be subject to income tax, or are they free from tax altogether?
Right. So the principles involved. income tax, which is tax on your income, the Section 62 charge that I discussed at the outset, does not apply to compensation awards. So it would not apply to any injury to feelings award. So it doesn't come into it because it's not an emolument from employment. It's not there to continue to ensure your continued service. Is it then subject to the Section 401 charge as a payment in connection with termination of employment? Well, if the injury to feelings is consequent or connected with termination of employment, then it's going to be subject to the Section 401 charge. But what I am saying, and let's do the contrasting case. If the guy brings, and this often happens in public authorities, brings a claim for discrimination, doesn't resign because they know they're going to find it really difficult to get the kind of earnings and defined benefit pension scheme in the private sector, so they don't want to give up they don't want to resign and give up their employment. In those circumstances, they continue with their employment, so there's no question of it being in connection with a payment in connection with termination of employment. That award for injury to feelings made for a claimant who continues in employment is tax-free. So great, happy days. Now, what you can say, even with the employee who has resigned, that yes, and it may be the best part, in most cases, it'll be the majority, is in connection with termination of employment. It may be all of it. But there will be those cases where there will be a history of discrimination, harassment that's caused injury to feelings, on which they haven't resigned, they've endured it, could be for months or even years before they finally leave. And there is scope there for saying, right, injury to feelings for that is not in connection with termination of employment. That is discrete and get it apportioned. And tribunals will, in my experience, if you ask them, assist in that. And if it is apportioned to that, it won't be subject to tax. If it's apportioned by the tribunal, it certainly won't be. Whether or not any apportionment reached between the parties is accepted by the revenue is a different matter. That's up to the revenue. You can't give any guarantees. All I can say is if it's a reasonable sum, which is within the Vento guidelines and a reasonable apportionment, the revenue are going to think, well, because they've got to have time and money to try and chase these to prove that it's not a bona fide agreement or a bona fide reflection. They'll leave it alone if it's a bona fide reasonable settlement, in my experience.
If an employer has a justified gross misconduct dismissal but offers a termination payment under a settlement agreement, can they justify not subjecting the payment to tax/NICs?
Well, I mean, short answer is no. Tax applies. So if on a gross, I mean, you see, if an employee has been caught with his hand in the till and gross misconduct and he is dismissed, then he gets nothing. He goes to the tribunal, he gets nothing. Employer hasn't been put to any loss or any trouble. If the employer then says, right, I'm going to try and buy off the risk of litigation and make a termination payment, I'm afraid Section 402 notice pay is going to apply, and they are going to have to. It's deemed notice pay. that's got to be subject to tax and they can't avoid it. So if you're representing a respondent, you've got to bear that in mind when you think, well, are we going to buy them off? Now, you can, their notice pay may have been, say it's 30,000 their notice pay, and you may only pay them £20,000. Well, it just means the whole of that £20,000 payment is going to be subject to tax. It doesn't prevent the employer from saying, look, we're not paying you any more than £20,000, but the respondent has got to know, A, I've got to subject that to tax, including national insurance contributions. And if you're for a claimant, you've got to know you're going to lose that, all the tax and national insurance contributions on that £20,000 pay settlement figure.
How does tax on car allowances work?
Right.
Or is this for a different session?
I did say that the big exceptions on the Section 401 charge was the legal costs and payments on account of injury and disability. In amongst the half a dozen or so other exceptions are car allowances and expenses and certain expense payments. So my advice to you on that one is, A, it's a bit of a different session, but whatever it involves, yes, go and look at the Section 401 provisions, because there are exceptions there for payments by way of expenses, including car allowances.
And finally, can tax liability be legitimately reduced by apportioning an amount towards a pension?
Well, you see, your claimed loss will include pension losses, but a pension loss right, yeah, I'd have to think about that one. But if the employer is paying the contributions directly into the scheme, I think they would be not subject to tax. The trouble is, in most of the cases when you're claiming a pension loss, you're claiming the pension loss, and the claimant just gets a lump sum, and that's going to be subject to a Section 401 charge to tax. So, yeah, I mean, that is one where you are going to have to, if you are trying to avoid the tax by making a payment direct into a scheme, then I think there may be potential for that, but that's something you're going to have to consider very carefully at the time. If you've simply got losses for pension and the payment is simply a payment in connection with termination of employment, it will be subject to Section 401 charge, even though the losses which it's making up are ones which, had he continued employment, would have been by way of pension contributions by the employer and not subject to tax.
That is all.
Lovely. Well, very interesting and stimulating. And even without the good offices of Paul, I think we've kept to time, which just shows what a complicated subject this is. Thank you for your questions. Very insightful questions, and you will be getting my handout on interest and tax, which is a bit of a novice guide to it. But if you do get something like that question on pension, you'll have to get brief counsel on that and get him to sort that one out. So thank you all very much, and have a good morning.